Welcome to the Broken Pie Chart Podcast. What episode is this? 318. That's which one it was. Okay. I'm your host, Derek Moore, and hoping to get Jay back maybe next week, maybe the week after. And working on a couple other guests we may bring in as well. Okay. So here's the deal. Do we get to 10% down? Not quite yet. Looks like as of the close on Friday, recording this on Saturday, actually. If we look at from the February 19th high, down about a little over 9% right now. Russell down 11.2%, NDX down 12.95%. The Mag 7 down 16.72%, the equal weight down minus 5.56%. And, a good high yield proxy is probably down about, 70 basis points. Of course, when we look at the Magnificent 7, the Mag 7, as we say, they topped out December 17th. They are now in bear market territory again. Haven't they gotten? Yeah, I think they're right about where they were. When was that? On the 18th, they reached the low, down 20.34. So the reason I bring that up is, Jay had asked, I think it was 2 weeks ago, do the big stocks, the big Mag 7, do they have to actually bottom out, start to turn, and do they need to lead the market? And the answer may be yes. They might need to do that. It's a shame because, the Mag 7 topped out December 17th. The overall market topped out all-time high February 19th. So you started to see the broadening out, but these are big companies, and the big companies, I think, do need to catch a bid here if we want to see, some real sort of bottoming action. And we'll get to whether this is a bottom or a double bottom-ish thing. First, I want to talk about inflation. Inflation, the news came in a little hot. 2.8% year over year, the core PCE inflation rate. And I got to be honest with you, people made a big deal about this and they said, well, it came in. Remember, whether or not it comes in higher than expected is different whether it comes in too hot. And what do I mean by that? Well, of course, what was just released in March is February's PCE and PCE Core and PCE Super Core and all that stuff. And of course, Core is X food, X energy. And Core was up about 2.8% year over year. Just US PCE inflation rate, not the Core, was up 2.5 less. Of course, energy has been down, as I think everybody knows. But, these are the February numbers. And we'd say, oh my, we haven't seen numbers this bad since, December. It's like 2.7% year over year in January, 2.9 in December, 2.8 in November, 2.8 in October, 2.7 in September. It's sort of been oscillating from May of 24, anywhere from 2.7 to 2.9, 2.6 to 2.9. There's only been 1.26 that was June of 24. So is this really a hot inflation print? Not really. Not really. I mean, I would say that the rate of change, the decrease in the rate of change has slowed because we've got this cluster. I'd say, March of last year was 3.0. February of last year was 2.9. But I would say basically from May until February, because we won't have the March numbers until April, we've sort of been, if this was a stock, you'd say, well, it's forming a base, but it's certainly not going lower, and it hasn't marched higher yet. So I think it was, and then, the expectations thing is another thing. Like if they thought it was going to be 2.7 and it came in at 2.8, they'd say, well, it came in hot. But did it come in hot, or were the analysts wrong on that? I think that's an important point to remember. So the other thing I think is worth really discussing with the markets right now, the sentiment is bad. Fundstrat, Tom Lee's group, put something out on Twitter Conference Board 1-year expectations for stock price increases. And over the last 2 months, it has collapsed. And what they do is they say, hey, a year out, what's your expectation for stock increases? And it was pretty high. But then this decline, over 40 years, it's the largest 2-month decline ever. And this goes to, hey, what are my expectations over the next year for stock prices? So is that a contrarian indicator? Maybe. Or, I mean, it just very, very quickly, the sentiment changed. You also look at something like, what's another one we'll look? Yeah, I mean, so this is Real Investment Advice. I don't know who that firm is, but they've got a logo and a name, so I assume that's theirs, via Isabel Net on Twitter. Net bullish sentiment score. And they have labels on it, so they're calling this Trump Trade War 2. And it is in, they call it net bullish score, but if it's at the lower end of the chart, I know you can't see the chart, it is kind of bearish. And you look back and you say, well, when is it like this? Well, the end of 22 it was like this. You go back to 2008, wasn't quite as low as the 2009. There was lower points in 2008, but is that contrarian? Maybe it is. Maybe it's not. And, you look at things like, whether it's the sentiment, you look at the conference board. I mean, is there enough, is the bearishness in the market, is it too much given that we're only down just under 10%? Even if you round it off to 10%. Well, you really can't round it. It's 9% right now. But we know we touched 10% down, was that 2 weeks ago? Week and a half ago? Is it too much? Like, does the expectations, have they changed so much in the Fundstrat thing in 2 months? You look at the AAII, we talked about that last week or the week before, how bearish that is. I mean, given we're only down that much, it seems like it's an overreaction. But, I don't know yet. I don't know. And then you kind of look and you say, okay, earnings so far have been, still the earnings expectations are holding up. But is that about to change? Sam Rowe had put something and tweeted it out. And this is from Barclays. Tariffs and deteriorating survey data lower our 2025 S&P 500 price target to 5,900 from 6,600. 22 and a half times our lowered base case EPS estimate of 262, and their prior was 271. So remember, we talked about, hey, so far earnings estimates are pretty lofty, 270-ish a share. And here's kind of the first of the big investment banks to kind of come in and say, well, hold on a second. We're gonna actually lower it. If I look, and Sam Rowe had and I think these are updated. He's got the year-end 2025 S&P 500 targets as of March 26th. And Oppenheimer is still, are they 7,000? I feel like Wells Fargo, it's a little tough to read. I think Wells Fargo is 7,000, Deutsche Bank is 7,000, Society Generale 6,750, B of A is like 6,600 if I'm reading that right. Morgan Stanley 6,500. Barclays is the lowest of the ones here, 6,200 for Goldman Sachs and RBC. So that's the question. Are we about to get a bunch of analysts come out from the big investment banks? And they can do two things. One, they can lower their forward 12-month EPS targets or estimates, and they can also lower their numbers. And of the two, the more significant one is their estimate. Because here's the thing. You could have 262 as an estimate and say, well, I think we're going to trade to a 23 multiple. Or you could say, I think we're going to trade to a 16-time forward multiple. I've always said, you could give me the exact numbers the exact earnings or the expectations, what they'll be December 31st of this year. Give me the full forward 12-month for 26. And I would say, all right, great. Now what's the multiple? I mean, that's really hard. That's why I hate these targets, and I hate these things. Although we do them, Jay and I do them every year. So something to keep in mind. Warren Pies had put something out on Twitter, and this is 314 Research. And I thought this was really interesting because the name of the piece is Confidence Game. I don't know how often this comes out or what the date was on this, but I believe it was put out March 20th is the date on this. And there's a chart, and it says the S&P 500 after 10% corrections. And there's two lines. And it says, what does the market do over the next 365 calendar days? You have the typical S&P performance. You've got the, let's see, a correction. So if you have a 10% correction with no recession the next 12 months, the market is typically going to be fine. It's going to be higher. Well, I shouldn't say it's typically. According to this chart, and I don't know how much data they're looking at. I don't think it really says that there. But if there is a correction, you would say, well, you'd expect it to trade sideways-ish to a little bit down. And that's the question. So are we actually going to have a recession? These are really tough to kind of label. Now, in their executive summary here, Warren Pies, I assume it's him who writes this. Their executive summary, it says, with a no recession base case, investors should maintain an offensive mindset and look to add equity exposure starting in April. Okay, so maybe there's something where they think there's going to be some weakness, and then in April it will kind of, even itself out. I don't think it's in this piece here that I'm looking at. Also in the piece, he said, credit spreads have widened a bit, but not nearly as much as they do during corrections that occur prior to a recession. I think the point he makes here is a really good one. And that is credit spreads are not indicating that there's a problem in credit markets or that there's a wholesale worry about, and this is my words, in the economy. There's not a wholesale worry about the economy. Because the reason why high yield bonds would sell off, and for anyone who does remember what the credit spread is, the high yield credit spread, it's what is the yield to maturity on high yield bonds, and what is the yield to maturity on treasuries? And so if treasuries, I'm going to make this up here, if treasuries are at 4% and high yield bonds are at 7.5%, you would say the credit spread is 350 basis points, or 3.5%. But credit spreads, they have widened a little bit. But the way they are now, they're not really indicating, they're not really as worried about, let's say, the markets as the people answering these sentiment surveys that we just talked about. And he also says, without a recession, 10% corrections are historically buying opportunities. So we'll see. I'll let you know in here whether we have a recession or not. But I'll get to that as well. Just kind of thinking about the recession stuff. So I think that's the question. And, S&P prior declines around recessions. This is from Goldman Sachs Investment Research. Is this all of them? Is this an exhaustive list? Maybe. And the median market over, let's see. Yeah, around... Well, it doesn't say the time frame, but S&P price declines around recessions. The median is a decline of about 24%. And there's ones all over the place. So this must be peak to trough. Okay, because it says 57% down in 2008 here or there. Yeah, and at one point it was down that much. It ended, 2008 was minus 37%. So this must be the trough. Yeah, peak to trough. Okay. So in other words, if the median is 24 and if we're going to have a recession and you get to the median trough, you would say, well, we'd be down another 14%. I'm not saying that's going to happen. But so, that I think is a very valid point to bring up. It's like, okay, do we think there's going to be a recession or not? Recessions are really tough to predict. Remember, 29 as the leading, quote unquote, 30 leading economists coming into 2023 were all but assured we were going to be in a recession. We were not in a recession. Markets rallied. Markets were up very nice that year. I like to look at a site called Econ PI. Thanks to Spencer Wright. He's been a guest with me. We're going to have him on again. He's been a guest of mine on this program as well. Turned me on to Econ PI. I think it's econpi.com, and then there's the index. And they run a grid, and it's the current economic conditions, they call it the BAR analysis grid. And what they do is they have a decline quad, an expansion quad, a recovery quad, and a contraction quad. And right now, the median of all those coordinates, and I'll put a link, in the show notes, but the median of all the coordinates, those actually are not indicating, they're right about the baseline. They're right in the middle. And for any of you who's not familiar with this, it's not necessarily screaming contraction, recession. And basically what they say on the chart is economy is vulnerable to a recession when the median of coordinates is past its peak and moves near the baseline. So it's near the baseline, but it's not sort of in the decline quad. What do they have in the contraction quad? Well, the yield curve spread, that has come back down. Remember, we saw some extension in 5s and 10s, 10-year in particular. And if you look at the 10-year yield versus the 3-month treasury, which of course is the proxy for the risk-free rate, that's the one that really matters. And that had widened. It had uninverted, and then that's inverted again. Is there any necessarily meaning to that? Are we imminently in a recession? I don't know. No, I'm not necessarily. I'm not saying either one, but you hear people say it's not when it's inverted; it's when it uninverts, and then you have the recession. But now it's inverted again, so I don't know. And then you also look at something like GDP Now. And GDP Now, I'll put a link to this in the show notes, is the Federal Reserve Bank of Atlanta. And what they do is, so we just recently, I think it was positive 2.5%, the final estimate for Q4 GDP. So as a reminder, the way that GDP works is you come to the end of the year, so December 31st, the end of January, you get the first estimate of Q4 GDP. It is an annualized number. So, this is not the way to do the math, but if it was 1% for the quarter, you'd annualize it to around 4%. Okay. So 2.5% annualized growth in Q4. And, so February, the second estimate, March, you get the third and final estimate, unless it's, revised years later. So it was positive. Atlanta Fed GDP, what that does is it is a nowcast. And essentially what that means is as new data is coming in, it tries to update its estimate for Q1. Remember, we will not get the first estimate of Q1 until the end of April. But what this does is it's a running thing. So as new data comes in, this started out in February of, right around plus 3%, topped out just under plus 4%. And then it was the March, let me pull this up again. Yeah. It was the 228. Yeah, the 228 update. When what they did was they had estimated the net exports. The net exports went way down. So people are pointing to this because it's currently negative 1.8% estimated GDP for Q1. And you remember the back of the napkin for recessions is if you have 2 consecutive quarters of negative GDP growth, you're in a recession. In reality, the NBER, the National Board of Economic Research, declares recessions. And sometimes they'll declare a recession. They'll tell you were in one 9 months later that you were already in one. So, but that's who actually calls the official recessions. And you can go to their website and you can see the dates of all the recessions that are on there. Of course, to take you back to Economics 101, GDP is equal to consumer goods consumption, investment spending, government spending, exports minus imports. So going back to the Atlanta Fed GDP now, what that did was the net trade balance, which is exports minus imports. What that is saying is we were importing a lot more than we were exporting. And some people have pointed to businesses taking things in, trying to front run the tariffs. We'll see what happens. In theory, if that was the case, you would expect it to reverse at some point. But it was very, very big change. And so if you look right now and you say, well, what's sort of the cause of, why is it minus 1.83? Well, net exports is minus 3.95%. So you think about GDP, you add up all these, and if there's a negative, so sum these. So consumer spending is 0.3, non-residential fixed investment 0.81. So if you just added those two together, it's 1.11%. You kind of get where I'm going there. And if those were the only two components of GDP, you'd say, well, it's plus 1.11%. Non-residential or residential investment is 0.10%. Change in private inventory is 0.6%. All these are positive. Government spending is 0.34. And then you have net exports minus 3.95. So you would say is if you take out the net exports portion of GDP, you'd have, what is that? A positive 2.15%. And I'm not saying that's what you should do, but just kind of thinking about isolating how big that number is and the impact. So then what happens here? Well, they update the Atlanta Fed GDP Now model. In fact, the next update will be April 1st, and that's ISM Manufacturing Index, construction spending. April 3rd, International Trade Full Report, ISM Services. So you see how this data trickles in. And it doesn't use the full exhaustive list of all the GDP inputs, but it uses quite a number of them. So, I'm going to watch this. I'm very curious to see. And what happens is the estimates very close to when the actual first release is. So, for example, the final nowcast for, let me just look when, so the final nowcast for Q1 GDP growth will be on April 29th. And then probably you're going to get the first estimate released, not the nowcast, but the first actual estimate released right around there. And then right away, April 30th, you get the initial nowcast for Q2. So I'm keeping an eye on this, and I'm keeping an eye on it to bring it back full circle to Warren Pye's point, and the piece that he had is, okay, if we have a recession, it doesn't mean we don't just trade flat for a while, but markets don't tend to be up, as much. They don't. If you sort of look at the difference, if we don't have a recession in the next year, you'd say that markets normally recover from a 10% correction. So we'll kind of see which one that happens. We bring this back to earnings, though, and the reason why we bring it back to earnings is that, remember I started off the show saying, and I need to talk about the VIX as well here. So remind me to talk about that. Well, you really can't, but I'll remind myself. But you look at this and you say, well, the forward 12-month estimate, the compilation, bringing in all the different investment banks and sources, 270.24 is the estimate. And we're trading at 20.65 times that estimate, which brings us to the 5580.94, the closing price of the S&P 500. And going back to the Barclays thing, so their number, they dropped it. They dropped it, what did I say, from around 271 down to 262. So let's say, the average or the median all comes down for the next, the forward 12-month earnings estimate, what they're going to be in the future, what the analysts are expecting, what they're guessing. Really, it's the guess based upon the numbers they know. And you'd say, well, if we stayed at a 20.65 forward PE ratio, and will we stay there? I have no idea. Goes up, goes down. We are at 23.3. Remember, this has been a valuation reset. This has been a multiple contraction thus far. We went from 23.3 down to 20.65 times forward expected earnings. The earnings estimates for the next 12 months actually went higher, but the multiple went down. But what if it's Barclays' number of 262? Okay. Then the market would have another 169 points to go. That it would be, that's 5410, 262 times 20.65. So, yeah, I mean, that's what I'm saying. Did the multiple come down because the market expected investment banks to lower earnings expectations? I don't know. Does that mean that if everybody kind of redraws their expectations and it comes down to 262 instead of 270, does the multiple go down further? Does it go up? I don't know. But there's other things too that are at play. That estimate that I mentioned, the 270, that's based upon a sales per share. So 270.24 is the EPS, the earnings per share in the S&P 500 for the next 12 months. There's also a sales per share estimate, which is 1977.02. And if you take the 270 and change into the 1977 and change, you get a net profit margin of about 13.7%. Now, a lot of people say, well, what if you revert to the mean? And the long-term mean is, I should know this, but I'm guessing if it's 10, my guess would probably be too high. And my argument has always been, well, these are different companies. You can't look at a net profit margin from the late 70s when you had a lot of industrial companies. But let's say that profit margin doesn't hold, and we assume the sales per share and the current EPS forward are right. Okay. Well, actually, not the EPS. The sales per share is correct. If you went down from a 13.7 to a 12.7 net profit margin, and that brings you from 270 down to around 251 per share. See, that profit margin is very sensitive. And of course, if you take the 251 times, let's use that same multiple, 20.65, that brings you to 51.84. All right, let's forget the profit margin. Let's say sales dropped. Let's say sales dropped about 7%. So that would bring it from 1977 a share down to 1835. If we stayed at the 13.7% net profit margin, gets us to earnings at 251. You're starting to see how all these levers come into play. And when you look at why a market goes up or down, or the attribution, it's revenue, it's margins, and the returns now, dividends that are paid, share buybacks. You buy back, imagine if companies tomorrow bought back half their shares. Remember that 270 estimate? Well, that's per share, right? So that would bring the earnings up to 540 per share. So share buybacks can help the stock market. Help you have less shares to divide the earnings into. The other side of this is, come April, we're going to be starting earnings season again. I know there's still some, I call it the silly season of earnings that come out. But we're going to be in the throes of earnings season. And companies have been beating earnings. How much they beat them by, maybe it's not as much as they have been. But the earnings estimates are what they are. And if companies are beating and giving good guidance, that's another opportunity. Could go either way. But to me, that's an opportunity. Maybe this pessimism that's in the market isn't warranted based upon companies' margins and sales and different things like that. And I think that's one of the other things. Maybe the multiple goes back up as earnings season comes out. Maybe earnings expectations go up and the multiple goes back up. That's one of the cases that for the market. What if AI continues to seep into the operating efficiency of different companies, and they can trim cost. Well, would that help margins? Probably. So we'll kind of see on that. Let me talk about VIX. The reason why I want to talk about the VIX is because the VIX curve inverted again. What the heck does that mean? Well, what it means is the spot VIX, the one that you see on CNBC, that went to 2165, I believe, 2165. And if you look at a chart of the spot and then the VIX futures months, so I think is this the April one? Yeah, that looks like that's the April VIX future. That's only 20.98. You go out to the May, 20.5, and then June is kind of the low point, 20.44. So what that's basically saying is right now, volatility is higher, and the expectation for a month from now, 2 months from now, is that it will be lower. And you have these inversions. We see this in one of our quant models that we run, where if the ratio of the front month or the spot gets, and we actually do it a little differently. We look at the implied volatility on SPY options across the volatility surface. So we look at things like 9 or 10 days. We look at 30 days, 90 days, different time frames. And when the near expirations, when it's inverted, sometimes that's a positive sign, because if that volatility does come back in, it sort of implies that the market is going to abase and at least firm up or move higher. And so, is the VIX very high right now? Not necessarily. I mean, I think it slipped down to a 17 handle on change recently. And sure, when you look at the VIX index compared to its long run average, it's higher than that. But it's not crazy high. And so, one of the things I look at, I mean, there's a few levels that we don't really, internally, we sort of look at, especially for our quant model. But, if you're kind of playing the home game and you're looking for the VIX to sort of spike a little bit, maybe shake out some of the weak hands, that 25 level is a little bit interesting. And the last time we got up there was, the beginning of March, kind of that March 7th, March 8th. Prior to that, December 18th. And then prior to that, you had the real big spike. That was on August 5th. So often when you have these spikes that go higher, and we're not there yet, sometimes that's kind of an interesting contrarian angle on the markets. And that expresses a lot of the investor actions who might be willing to pay up for protection, which is kind of, we would say always be hedged, but it's kind of like what Jay and I always say, he lives in Florida. It's like, hey, a Category 5 hurricane's off the coast. Don't have hurricane insurance. Call your insurance company. Hey, this thing's hitting tomorrow. Kind of want to buy some hurricane insurance. Do you think that's going to be pricey? If they'd even sell it to you, who knows? So the VIX it's definitely something I'm watching. And if you are on the bullish side, you want to see this inversion. You want to see. Now, this can stay inverted for a while, like 2008, 2009. I mean, the whole VIX curve went higher and the front month stayed for a while above the back months. So it doesn't mean that it's only short term and it's going to correct itself in a day or two. But this is something if you're trying to make the bull case, you'd say, well, near-term volatility spiked across longer-term volatility. I mentioned high yield bonds before, and I think it's worth noting that when you look at high yield bonds, for example, if I go use, let's say, short-term high yield bonds, something like SJNK, which is a State Street short-term high yield bond index fund, and I look from February 19th, what's the total return on that? Well, it's down about 0.94%. And if spreads were really widening, and remember, when we say spreads widen, it means the yield to maturity shoots up on high yield bonds, especially because they are selling off. So now if you buy them and you get it back your money at par, or you assume that, whether or not that happens, that's different. But you get your money back at par plus the coupon, it forms the yield to maturity. So bonds are not really selling off. In fact, when you look at the equity markets that are down from the all-time high of about 9%, bonds are only down 0.94%. And that's a good enough proxy as any, in my opinion. I mean, correlations longer term, high yield and equities, probably more in that 60% range, 65% range. So the fact that high yield is not moving, remember I always say someone is right, someone is wrong. But so far the bond market is not flashing fear signals, especially in yield spreads and especially with the performance. Okay, last thing I wanted to cover is just, I think I mentioned I want to look at the implied volatility of some near-term SPX options. So SPX index options expiring April 4th, which is next Friday. And I want to look at the implied volatility. Implied volatility is right around 25. Right around 25. And what does that mean? It means when the option market is pricing out the options right now, what is it expecting? Well, it's 252 trading days. The square root of 252 is 15.875 and a bunch of numbers. You take 25 divided by that and you get 1.575. So call it 1.58% right now. And what that's saying is the expected, the bell curve in high school, 68% of the time, the values are between, I'm using my fingers here and here. You'd say a one standard deviation move is plus or minus 1.58% right now, which is high. That's high. And you can see that in the volatility, in the 25 vol right there. So when you see that, that is telling you the market is expecting around a 1.5% move each day. Could be up or down. And that's really the close. That is the, from where it's, it doesn't matter. Like intraday, it can move more or less, but it's saying over, a 1 day trading session. So right now the market is expecting volatility. It's pricing it in. It's pricing it into the options. When you go out and you say, well, let me look at a different expiration. And I'll just randomly pick April 25th. Okay. April 25th. And I'm not saying that, if I just kind of look at, look at the same thing. Yeah. I mean, volatility is just about 20. Now, volatility in the short term will affect different parts of the chain, meaning the back end will go up as well, just not as much as the front end. So when we're seeing these moves in the market's already expecting, 1.5% moves. S&P was down 112 points. And, when you look at that, you say, okay, well, options market is sort of pricing volatility. I would say that it was underpricing the volatility for yesterday. It could overprice or underprice or price it just right for Monday. But we'll see. These are things I'm keeping an eye on. All right. I watched The Gorge, a movie on Apple TV Plus. I kind of enjoyed it. I thought it was a good watch. It was only 2 hours long. You've heard me say this before. Like when you have a series and you're like, oh, I'm in for like 20 episodes now, or you go back to the stuff from the 90s, like The Sopranos or The Wire, and you're like, you really got to be committed, or Breaking Bad. So The Gorge has Miles Teller, Anya Taylor-Joy, and I thought it was entertaining. I think it's a movie you watch once, but it's entertaining. So I would give it a buy recommendation. It's I thought it was decent. If you have Apple TV Plus, which I think anybody who has an Apple phone or something, or maybe you know what? I don't even know. I'd ask Siri, but she doesn't know. That's a whole other discussion. Like, why can't Apple make Siri better? I don't understand. People with the Google Assistant seems to be pretty good. They were supposed to have AI in these phones, and Siri is not great. Not great at all. All right, Derek.Moore at ZegaInvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. If you can do me a favor, don't rate us anything less than 5 stars. But if you go on there, apparently it matters. So, getting ratings like that is helpful. 5 stars, leave a nice comment, those types of things. Even better, though, share these episodes. Take the episode and forward it to someone that you know or someone you don't know. Although I guess that would be a little weird. But anyway, you know what I'm saying. And here's the last thought. Right now, try not to watch the news, try not to watch too much reporting where everyone's trying to guess this stuff. And if you are set up well, if you already have, you've worked with us or you're working with, anybody, and you've got like, here's the things I need to do. Here's the goals. Like, stick to it. Try not to get distracted by all the noise. Because remember, 29 out of 30 economists said we were almost sure to have a recession in 23. We didn't. Sometimes predictions are only worth the paper they're put on, which isn't much. All right, everyone. We'll talk to you next week.